Welcome back, best ever listeners, to another episode of Passive Investor Tips. I'm your host, Travis Watts. Got a really short but exciting episode for you today. What we're talking about is how to vet a syndication deal, my 5 steps in 5 minutes. Disclaimers as always, never financial advice, not telling you or anyone what to do with your money. Please seek licensed financial advice when it comes to your own investing. So with that top of mind, the first thing I just want to say is what I'm sharing with you today are my steps to vetting a syndication opportunity. So it doesn't mean that they should necessarily be your steps, and you may have more that you want to add to this criteria, but I just want to explain the process from a high level in hopes that it'll add some value for you. So let's dive into it. I'm going to give you the 5 steps, and then I will break them down into more detail. Number 1 is to know your goals and what it is you're trying to achieve. Number 2 is to seek investments that help you move closer to your goals. Number 3 is to find operators who are best in class at what they do. Number 4 is to conduct thorough and proper due diligence. Number 5 is simply to take action and invest. All right, so let's talk about knowing your goals and objectives. I really encourage you to take a little time on this. This may take you an hour, this may take you a day, this may take you a week, but the more thought you put into it, the more clear you're going to get, the more success you're potentially going to have as an investor. So what I mean is knowing your true why. What are you trying to do? Are you trying to retire early? Are you trying to get more time with your family? Is it a passive income goal that you have? Is it a net worth goal that you have? So ask yourself the why. If it's a passive income goal or a net worth goal, why is it that amount? If you had that amount today, how would your life change? What would it look like? How would it be different? Is that really what you're after? And in regard to finding investments that match up and align with your goals and objectives, again, you got to go back to the drawing board. If it's financial independence, that's your goal, then you have to take it a step further. Is it passive income or is it net worth? In other words, do you want to sell off investments or assets to live on those potential profits? Or do you want to live off cash flow that real estate produces? These are very, very different because there's going to be investments that better align to each of those scenarios. For example, maybe a new development deal doesn't produce any cash flow for X amount of years, but has a potential for a higher sale price down the road. So that's an equity-focused goal if you're perhaps trying to build up net worth and equity. Whereas a stabilized cash flowing asset, or even things like maybe a debt fund in the form of a syndication, could perhaps offer you a higher cash flow yield, maybe even on a monthly basis. That may align more for living on passive income. And number 3, in regard to operators and finding best in class operators, you certainly want to read reviews online. You certainly want to have actual conversations with these operators before you decide to invest with them. I love to do in person when that's practical, but if it's not, I like to do Zoom. And if that's not an option, which it should be, in my opinion, then just maybe a phone call. So you want to seek out testimonials. You're looking for transparency. You're looking for groups that are putting out content. They're putting themselves out there. They're not hiding somewhere behind the walls. They're really out there in the industry. Maybe they're writing books, maybe they're hosting a podcast, and you want to watch and make sure that whatever their mission is, that it aligns with your mission, that you're on the same page about things, that you feel that this is a trusted operator. I also like to work with operators that specialize in a very particular niche, and they do that very well. And in regard to conducting thorough due diligence, you certainly want to start by just reading through the PPM, which is the private placement memorandum. Again, you want to look at track record. You want to ask your questions. Maybe they had a deal that didn't perform well, or maybe they had a capital call, or they lost money on an investment. You want to ask the tough questions ahead of time. And you want to make sure that the operator, the market, and the deal all pencil out for you and meet your criteria. I also like to try to visit the property ahead of time before I decide to invest. And if that's not a practical option for you, you could also do a virtual drive-by using something like Google Maps online. And the overarching theme here when it comes to due diligence for me is trust but verify. If they say the rents are 1,500 a month today, we want to lift them to 1,700. I hop on sites like apartments.com. I search for that particular submarket and I look at all the competitors and I have to ask myself, is that realistic? Are newer renovated properties renting for 1,700 or higher, or are they only renting for 1,600? In which case, they're suggesting they would be the highest priced apartment community in the area. To me, that would be a red flag. And step number 5 is to take action and invest. A lot of investors, myself included years ago, would get caught up in analysis by paralysis. You're just looking at deal after deal after deal after deal. Then you're finding it hard to just make a decision or to actually take action. The problem with that is, what are you leaving on the table if you're going to take that approach? For example, let's say you want to find a deal that produces an 8% cash on cash return in year number 1, but you're not seeing any of those deals right now. So you say, well, I'll just wait till the right opportunity comes up. And let's say it takes you 6 months before a deal like that pops up that meets your criteria. Well, what did you leave on the table? Essentially 6 months or half a year's worth of returns. So technically that 8% yield just turned into a 4% yield. So perhaps it would have been wiser just to do a 6% deal 6 months ago and have a higher overall year 1 return. Something to think about. So with all of this, I wanted to keep this episode short and to the point. I recognize it was a bit high level. I didn't go over all the details. So if you want to take a deeper dive, simply reach out to me. I'd be happy to connect over Zoom or a phone call, whatever works for you. Travis Watts or at Passive Investor Tips. Hope you found some value in this episode. Make sure you like, subscribe, and comment. Share these episodes with anyone that you think could find some value. You're listening to Passive Investor Tips right here on Best Ever. I'm Travis Watts. I'm grateful that you're here with me today. We'll see you next week on an all-new episode. Until then, have a best ever week, everyone.